Welcome to the deep dive. Today, we're tackling something really crucial if you're a business owner focused on growth.
Hmm.
How do you actually keep more of the money you make and, protect what you've built along the way? We're zeroing in on tax efficiency and maybe surprisingly, the role trusts can play in all this.
Exactly. Businesses often get hyper-focused on just boosting revenue, and that's vital, obviously. But managing finances smartly, especially taxes, well, that's the engine that really drives growth, often overlooked.
It's like plugging leaks in a bucket,
Yeah,
right? So you can actually carry more.
precisely.
Now, I know when we say trust, maybe your mind jumps to, I don't know, huge estates, very wealthy families, that kind of thing.
Mm.
We want to hit pause on that image right away.
Yeah, that's important.
While trusts are used there, they're definitely not just for the ultra-rich. They can be incredibly useful tools for, well, lots of different business owners. People looking for smart ways to handle assets, cut down their tax bill, and, just secure the future of their business.
hmm So our mission today in this deep dive is really to uh, demystify things, cut through that complexity. We want to show you how trusts, along with other smart tax strategies, can genuinely be a game changer. We've looked at various sources, the basics of trusts, broader tax efficiency ideas, even specifics for LLCs. The goal is to give you some solid, actionable stuff to think about for your own situation.
Okay, great. So let's start right at the beginning then. In simple terms, what exactly is a trust? And why should a busy entrepreneur even, pay attention?
Okay, so at its absolute core, a trust is just a legal setup. It's an agreement. You basically hand over control of certain assets, could be cash, property, maybe even shares in your company,
Okay.
to someone you pick, called a trustee. This trustee manages those assets based on specific instructions you provide, all for the benefit of people you name the beneficiaries.
Huh. So it's a bit like setting up a dedicated holding company, almost, with its own rule book.
That's a pretty good way to think about it, yeah. Like a trusted manager for specific assets following your plan.
Right. Makes sense. But what's the real bottom line? Why go through the trouble? What are the main advantages for a business owner?
Well, our first source really lays this out clearly. The big benefits cluster around optimizing taxes, protecting assets, and making wealth transfer easier. If you structure a trust strategically, it can potentially mean, well, quite significant savings on estate taxes later on, and maybe even income taxes right now.
Wow. Okay.
Think about passing your business to the next generation, maybe family, maybe key employees, with a much smaller tax hit. That helps ensure it continues, right?
That's huge, especially for family-run businesses. A massive consideration.
Absolutely. And secondly, there's asset protection. A properly set up trust can act as a pretty strong shield for your business assets.
A shield. How so?
Well, assets held inside the trust might be protected from personal liabilities or even business lawsuits and creditors.
Ah, I see.
It gives you this extra layer of security, a kind of safety net if things get unpredictable, which, business can be.
That peace of mind sounds incredibly valuable on its own.
It really is. And the third piece is smoother wealth transfer. Trusts let you control exactly how and when assets are passed on, completely according to your wishes.
Yeah.
You avoid probate court, which can be long, public, and costly. It just makes the whole process more efficient.
Okay.
So ultimately, like the source says, it's about keeping more of your hard-earned money to reinvest in growth and worrying less about the tax side of things.
Right. Concrete benefits than financial strategic.
Yeah.
Okay, let's dig a bit deeper on the tax side. Our second source mentions specific types like REITs and Innovates. They sound pretty specialized. How do they fit in? What's the tax angle there?
Yeah, REITs, real estate investment trusts, and infrastructure investment trusts are interesting structures. They're designed specifically to channel large-scale investment. Think of a REIT like a company that owns, say, shopping centers or apartment buildings funded by lots of different investors.
Okay.
And invites pool money for big infrastructure stuff, highways, power plants, that sort of thing.
Gotcha.
The really appealing part, tax-wise, is how they're often treated. Frequently, the income generated isn't taxed heavily at the trust level. Instead, it's typically taxed when the individual investors receive their distributions, their share of the profits.
Ah, so it avoids that potential double taxation layer.
Exactly. Or at least significantly reduces the overall tax burden compared to some other structures. This makes it way more attractive for both the companies running the projects and the people investing in them.
So it basically frees up more cash within the structure.
Precisely. More capital for reinvestment, for expansion, for new projects. It directly spurs growth in those sectors, real estate and infrastructure. And what's quite interesting, as that source notes, is the ongoing discussion about maybe extending similar tax advantages to other types of business trusts.
Oh,
Yeah, imagine if more kinds of businesses could use these super tax-efficient trust models to attract investment and grow faster. It could really ripple through the economy. Makes you think, doesn't it?
it definitely does. Food for thought there. But okay, these specialized trusts are one thing. What about, the average business owner? Not everyone's building power grids. What are some broader tax efficiency strategies that any business could look at, whether or not they use a formal trust? Source 3 seem to cover this.
Absolutely. Let's zoom out. Tax efficiency isn't just about complex legal structures. There are fundamental best practices,
Yeah.
foundational stuff. It really starts with being super diligent about claiming every single available tax deduction. Are you positive you're catching all legitimate business expenses?
Things like home office, supplies, travel.
All of it. It's amazing how often businesses leave money on the table by missing simple deductions. It adds up.
Yeah, I bet.
Then there's the business structure itself.
Yeah.
Choosing the right legal form, sole proprietor, partnership, LLC, S Corp, C Corp, that has huge tax implications.
Right. That initial choice matters a lot.
It really does. You need to understand how each is taxed and pick what's truly optimal for your specific business and income level. It might even change over time.
So like maybe starting as an LLC, but electing S Corp status later if it makes sense tax-wise.
Exactly, that kind of strategic thinking. And beyond structure and deductions, there's timing. Strategically timing, when you recognize income or incur expenses, within the rules, of course, can help manage your tax liability year to year.
Okay. Like maybe buying needed equipment before year end?
Could be, yeah. Or deferring some income if possible and allowed. And finally, don't forget tax-advantaged accounts, especially retirement plans. Things like SEP IRAs or solo 401k let you save for the future and get potential tax breaks now.
Right. Double benefit.
So these strategies, maybe less flashy than trusts, are absolutely essential building blocks for keeping more capital to fuel growth.
Makes total sense. It's about being smart and proactive everywhere.
Yeah.
Now, you mentioned LLCs. Our fourth source went into specifics there. What are some of the particular tax advantages limited liability companies offer?
LLCs are really interesting because they're so flexible, tax-wise. That's a key point. Unlike, say, a corporation, an LLC doesn't automatically have its own federal tax classification. Instead, the owners, the members, get to choose how the IRS treats the business for tax purposes. It could be taxed like a sole proprietorship or a partnership, or even like a corporation, either a regular C Corp or an S Corp. This ability to pick the tax treatment that fits best is, well, a major plus.
So you can sort of tailor it to your situation. Find the most efficient tax bucket, like you said.
Exactly. And of course, LLC owners can deduct all those legitimate business expenses we talked about: supplies, travel, professional fees, maybe part of your rent or mortgage if you have a qualifying home office. That directly cuts down taxable income.
Standard deductions, but important.
Very important. And the source also highlights setting up retirement plans through the LLC. Again, things like solo 401k or SEP IRAs, big tax advantages there, both for contributions and the growth.
Right, reinforcing that point.
And one really practical tip from the source: using software. Good accounting or tax software to track expenses meticulously and even help automate filing.
Why is that so key?
It just makes compliance so much easier. Less chance of errors, fewer missed deductions. It streamlines the whole painful process and helps make sure you're not accidentally overpaying.
Yeah.
Reduces the headache factor significantly.
Yeah. Avoiding headaches and saving money. Good combo.
Yeah.
So flexible structure plus diligent financial management. Okay, so our last source kind of ties things together. It talks about the connection between just good, solid tax compliance and actual business growth. How does simply staying on top of your taxes help a business expand?
Yeah, this is a really crucial connection that sometimes gets missed, I think. Being proactive about tax compliance isn't just about, avoiding audits or penalties, though that's obviously important.
Sure.
It's actually a fundamental driver of growth. Think about it: when your financial records are accurate, organized, maybe managed with cloud-based software like the source mentions.
You know where you stand.
Exactly. You have a crystal clear view of your company's financial health. That lets you make much smarter, more informed decisions about where to invest, when to hire, how to price things, all the decisions that fuel growth.
Right, data-driven decisions.
Precisely. And by cutting down on errors, maybe automating some of those repetitive tax tasks, you, the business owner, free up so much time and, frankly, mental energy.
Less time wrestling with spreadsheets and tax forms.
You got it. And that time, that energy can go directly into what actually grows the business, developing products, finding customers, improving operations, strategy.
Focusing on the core business, not the admin.
Yes, you shift from being reactive, just trying to keep up with tax deadlines, to being proactive, focusing on strategy and growth. It's a mindset shift enabled by good compliance.
Okay, wow. We've definitely covered a lot of ground. Trusts, deductions, structure, compliance. Let's try to pull this all together.
Yeah.
For that business owner listening, the one really focused on growth, what's the main takeaway message here?
I think the core message is view tax efficiency not as some annoying chore, but as a vital strategic tool for growth. It's fundamental. And while trusts might seem complex at first glance, they offer a really powerful set of options for boosting that efficiency. Think tax savings, asset protection, smoother succession planning.
Right. But it's not only about trusts, is it? We also hit on those other crucial pieces.
Oh, absolutely not. It's the whole picture. Making sure you're maximizing deductions, choosing the smartest business structure for tax purposes, planning your finances proactively, and just maintaining disciplined, accurate
All
compliance.
working together.
Exactly. All these pieces combined create a business that's financially stronger, more resilient, and just better positioned to grow sustainably. And for honors with those specific long-term goals, passing the business on, protecting significant assets, seriously looking into how trusts could fit strategically is definitely worthwhile.
Okay. So as we wrap up, what's maybe one final thought or question you'd leave people with? Something to really mull over about their own business.
I'd encourage you, the listener, to just take a moment and honestly think about how proactive you currently are with tax efficiency. Are you mostly just reacting when tax season rolls around? Or are you actively looking for ways to optimize, to protect, to plan? And specifically on trusts, even if they seem intimidating now, could exploring them further, understanding them better, potentially unlock some real advantages for your business's future, for your own financial security.
Hmm.
It's definitely an area where putting in some time, maybe talking to good financial and legal advisors who really know this space, could pay off significantly down the road.